Hello everyone, today is February 11th. Time for another market breakdown. We've got fresh non-farm payrolls data out today, and the bigger picture is starting to become clearer. So what we're going to do is use the three major indices as our core framework and try to project, or at least anticipate, how this next leg of the market might unfold. Today's analysis may not be very long, but it's extremely important because frankly, the market just told us a lot about what the next phase could look like. Let's start with the non-farm payrolls report. The number came in way above expectations, and not just slightly above. It significantly beat estimates. Now yes, the Bureau of Labor Statistics did revise down the 2025 employment data, so technically last year's average monthly job gains were actually lower than previously reported. That adjustment suggests the labor market in 2025 may not have been as strong as initially believed. But here's the key. January's payroll number massively beat expectations, and that single data point just set the tone for what comes next. Because what this does is it deals a serious blow to rate cut expectations. Even someone like Kevin Warsh, who is reportedly preparing to take a more influential role, would have a very hard time convincing the Federal Reserve to aggressively comply with President Trump's strong push for rate cuts under these conditions. Right now across Wall Street, the consensus view has shifted. Most analysts now believe that rate cuts have been pushed back, likely no earlier than July. So the market is on edge. You can see it clearly in the bond market. Treasury yields spiked sharply today, a very aggressive move higher. And when yields surge like this, it puts pressure on the entire liquidity system. Higher yields mean tighter financial conditions. It affects borrowing costs, it affects valuation models, it affects risk appetite. Any part of the economy that depends on cheap capital in anything that requires continuous liquidity blood flow feels that pressure first. And if you look at the charts today, you can already see the market reacting to that shift. Now let's go back to the charts of the three major indices. What I'm about to discuss is a forward-looking scenario, and I would say the probability of this scenario is increasing. Over the past few videos, we've already talked about how the trend was still technically intact. Yes, price was consolidating at elevated levels, but as long as we didn't break below 22,000, and more recently the key 2,500 level we mentioned yesterday, we weren't making any formal call about a trend reversal. But now the macro backdrop has shifted. The fundamental environment has changed, so we need to reassess. Let's start with the Nasdaq. At this point, the Nasdaq is beginning to form what looks like a potential topping structure. I'll say that again, a developing top. It's not confirmed yet, but it's enough to trigger early warning signals. Now let's move over to the Dow Jones. After breaking above 50,000, the Dow has printed two daily candles with long upper wicks at these elevated levels. If we zoom into the 4-hour chart, we see the same thing. Sustained pressure at the highs. And when we look at order flow, including the order flow data, we can clearly see that core resistance in the Dow is starting to show itself. The real overhead supply is beginning to emerge. Even from the volume footprint perspective, we're seeing selling pressure at these highs. You can see it here, pressure at the highs. Here as well, pressure at the highs. And into today's close, again, pressure near the top of the range. So if even the Dow Jones can't escape this overhead pressure, what does that tell us? It tells us that across all three segments of the US market, high growth tech, Nasdaq, broad large cap tech and growth, S&P 500, and traditional industrials, Dow, we may be looking at a developing topping formation. Now the S&P 500 does look slightly cleaner structurally, slightly better, slightly more orderly. But even so, it's still facing significant resistance at elevated levels, significant overhead supply. Previously, we described this structure as a gradual rising wedge, but now the resistance at the highs is clearly becoming visible. Around the 7,000 level, we've tested that top 4 times. One test, 2, 3, 4. Each attempt failed to break through. When you repeatedly test a major resistance level and fail to clear it, the probability increases that price will rotate back down toward the prior swing structure. In this case, the 6,800 area. That prior peak to trough level now becomes a very important downside reference. So whether we're looking at the S&P 500 or the Nasdaq, the topping behavior is there. And the Nasdaq's structure is even more concerning because the new high it just printed is actually lower than the previous high. Have you seen? Take a close look. The recent peak is lower than the prior peak. That's significant. That means we may be looking at a lower high forming at elevated levels, which is often an early technical sign of distribution. On top of that, price action has created what resembles a false double top formation at the highs. And now, with today's fundamental shift layered on top of this technical setup, the context becomes even more critical. Let's circle back to a topic we discussed before, the idea of a potential doomsday scenario for software stocks. And honestly, I don't think that's fear-mongering. You also shouldn't blindly rely on Wall Street narratives that are designed to calm investors down, telling everyone not to worry, that everything is fine. This isn't about short-term reassurance. This is about understanding where we are in human development right now. Since the AI revolution truly accelerated, you can feel it. Whether you're an ordinary worker, a tech professional, or a white-collar employee, AI has already penetrated nearly every aspect of our industries. Fields we once believed were irreplaceable. Creative industries like music, painting, filmmaking, short-form video editing, even certain types of writing and literature are being gradually disrupted. And now with AI agents, autonomous systems that can operate online and execute complex tasks beyond what most people imagine possible, we're starting to realize how many roles, how many tools, and how many categories of software could eventually be replaced. Just like during the internet era and the mobile internet era, when traditional industries were overturned, this shift has the same disruptive potential. So when we talk about a software reckoning, there are some important representatives of that theme. One of them, in my view, is Microsoft. Now think about it. Microsoft is absolutely a software company. In fact, it's a classic subscription-based software model. But is it also an AI company? Yes, it is, because it owns a significant stake in OpenAI, and it has deeply integrated AI into its own product ecosystem. And yet, despite all of that, Microsoft has sold off hard recently. It's been hit pretty significantly. So what we're seeing in the US equity market right now is a tale of two markets, a clear bifurcation. On the left side, you have traditional software companies that are not core AI infrastructure players, not foundational AI engine providers. That entire segment has been under pressure. It doesn't matter how strong the earnings are. Look at Amazon, same story. Consecutive gap down openings. Traditional e-commerce, even with solid fundamentals, is struggling in this environment. That's the left side. Now, what's on the right side? On the right side, you have AI-driven semiconductor and infrastructure names. Take NVIDIA, a name everyone knows. During broader market pullbacks, NVIDIA hasn't experienced the same magnitude of drawdown. It's still the largest market cap stock in the world. And today, let's add another name, Vertiv. Vertiv rallied strongly today. Big move higher. What does Vertiv do? They specialize in liquid cooling systems, water cooling infrastructure for data centers. And this is critical. When you build large-scale data centers and high-performance compute clusters, you can't just throw in a few air conditioners and call it a day. These servers require internal liquid cooling systems to function properly. Without liquid cooling, these compute clusters can't operate at full capacity. If the hardware overheats, you might only be able to run at 20% or 30% of total compute capability before throttling kicks in. At that point, you've essentially wasted your capital expenditure. So liquid cooling is a niche within the broader semiconductor and AI infrastructure ecosystem, but it's a crucial niche. Vertiv beat earnings expectations, and the market rewarded it immediately. So what are we seeing? Left side, traditional software. Right side, AI-linked semiconductors and infrastructure. This is a highly polarized market structure. Up until recently, the semiconductor sector alone was strong enough to support the broader investment narrative. It was the backbone of the bull case. But now, that's no longer sufficient. Why? Because the macro fundamentals have shifted. After today's data release, the market is no longer being driven purely by earnings growth or long-term AI narratives. That story alone cannot carry valuations in the short term. What matters now is liquidity. What matters now is monetary policy. When rate cut expectations get pushed out, when Treasury yields spike, the market stops trading on story and starts trading on financial conditions. So in the near term, I do believe warning signals are flashing. The alarm is ringing. At this stage, risk management becomes critical. If you're holding short positions, this is where you should consider hedging accordingly. Put on protection where necessary. Manage exposure proactively. That said, high-quality companies, truly strong names, are still worth holding. Take Datadog, which we mentioned yesterday. Yes, technically it falls under the software category. But what kind of software company is it? It's infrastructure software that is essential to the AI ecosystem. That makes it more of an AI adjacent enabler than a traditional legacy software name. And what happened today? Gap up at the open and continued higher. Strong follow-through. That's the one we highlighted yesterday. And look at Tesla, a more traditional large cap name, still trending decisively higher. Very strong. Extremely resilient. So when you own high conviction, high quality stocks, don't panic sell them just because of one or two pullbacks. In the short term, I do believe the market is likely to retrace. A pullback looks probable, but the long-term trend remains intact. The bigger picture hasn't changed. The AI narrative hasn't collapsed. The semiconductor cycle hasn't broken. The broader bubble, if you want to call it that, has not burst. Will traditional software eventually face structural disruption? I believe so. It's probably a matter of time. That transition could even happen sooner than many expect. But in terms of overall market valuation, what we're seeing right now is more of a liquidity reallocation than a systemic collapse. Capital is rotating, not disappearing. There's no need for extreme panic. If anything, the areas that may face more volatility could be commodities, possibly crypto. But if you're holding high-quality equities that represent the future direction of technological and economic development, you should maintain conviction. So to summarize today, first, the broader environment is flashing warning signals. Second, high-quality stocks remain worth holding. Third, If you're running short exposure, consider appropriate hedging strategies. That's it for today's breakdown. If you have any questions, drop them in the comments or join the group discussion. We'll continue tomorrow.